This is ECT 3-1 class, so intermediate accounting. The tutor in charge is Dr. Alimi AA. So by God's grace, we are going to do justice with study session 1 and 2 today, if time permits. Otherwise, we just stay with study session 1. So to start with, permit me to share my screen. So I want to be using PowerPoint as well as the study materials together. Sorry, it's still loading. So can you see my screen? Please, if you can see my screen, please let me know. Signify.
No, sir.
I can't hear you.
No, sir.
No, sir.
Okay.
No, sir. No, sir.
Okay. Can you see it now?
Yes, sir.
Yes, sir.
Okay, thank you so much. I said something the other time. I said this is study session 1, and the course itself is it's the 313 intermediate accounting 1. So we have the following learning outcomes. So number 1, we'll be talking about the conceptual framework of International Accounting Standard Board. Then we'll be talking about the status and scope of IASB framework, that is International Accounting Standard Board. Then we'll be talking about the under that we'll be talking about the objectives of International Accounting Standard Board. Then we'll be talking about the qualitative characteristics of financial statements under learning outcome 2. Then we'll be talking about element of financial statements. Then finally, the 4th learning outcome is concept of capital maintenance. So this is just the introductory aspect of the course. So let me quickly talk about what the introduction aspect is all about. As we all know that the main purpose of this course is to enlighten us or to put us through how the financial statements is being prepared, what are the things that we are required during the preparation of financial statements, then what are the contents, the minimum requirements that the users of financial statement might required for them to make an informed decision. So those are the things that we need to understand as far as this course is concerned. So if you look at the word financial statements, do you understand? So financial statement is prepared for the benefit of the users. So not the statement itself, but the information therein. Do you understand? So the information on the report, that's the main target. And those information are only useful for who? For the users or the stakeholders, the financial statements. So financial statement possess certain qualitative characteristics that enhance the usefulness of what? Of the information they convey to a wide range of users. You understand? So in this study session, we shall look at the elements and desirable quality of financial statement. Also look at the concept of capital and capital maintenance from the point of view of accountants. So that is exactly why we are here today. So, but before we delve into the financial statement itself, let's try to look at the regulatory body that are saddled with the responsibility of putting some contents together before we can say we have our financial statement. In July 1989, the International Accounting Standard Board Committee, now replaced by International Accounting Standard Board, produced a document titled Framework. Let me just say something about IASC and IASB. IASC is International Accounting Standard Committee. They are the ones saddled with the responsibility of producing International Accounting Standard, that's IAS. Due to the recent development in accounting standards, so the accounting standard has been harmonized to the extent that the world is now a global village, whereby if you are preparing an account in Nigeria, so the same way you prepare a particular account, let's say a statement of financial position in Nigeria, that's the same way you'll be preparing a statement of financial position in other part of the world. So that's why I said it has become a global village. So then this ISC, they are the ones saddled with the responsibility of producing the IAS, that's the International Accounting Standard, before it has been replaced by IASB, that is International Accounting Standard Board. So the International Accounting Standard Board, they are the ones saddled with the responsibility of producing International Financial Reporting Standard, that IFRS. So that is why if you, sometimes you may see that some IA has been replaced by IFRS because the IAS, they are going into extinction. We have 41 IAS produced by IAS. So presently we have 16 IFRS produced by IASB. So, but the IASC has been replaced. So IASC has been replaced by IASB. So automatically IASC has gone into extinction. So since the IASC has gone into extinction, there is no more IASC. So that shows that the IASB has been replacing, the IFRS has been replacing IAS. So that is why what we are dealing with currently is IAS and IFRS. But sooner or later, we no longer have IASB. So now this, then let me just try to clear one here about the framework. You know, the framework we'll be talking about here is conceptual framework. The conceptual framework is not an IFRS, it's not a standard, do you understand? But framework helps standard, it assists standard, it assists, let me just say, it assists all these putting up the standards together, do you understand? So that's why if you see a particular element or item whereby IASB and IFRS, if there's a conflict between the two, so it is the IASB that will prefer. Do you understand? What I mean is, if there's a conflict between one particular IFRS and the framework, it is the IFRS that will prefer. Do you understand? So this document will now set out the concept that determine how financial statements are prepared and the information they contain. So this is why the IASB is also called the conceptual framework. But the framework itself is not a standard. So what exactly do you understand by conceptual framework? That's the first learning outcomes. It talks about the conceptual framework. A conceptual framework is defined as a set of objectives and principles that can lead to the production of consistent accounting standards. Consistent accounting standards. So this framework is therefore the conceptual framework. That is the frame of reference from which the accounting standards are issued by the IASB is constructed. So any set of objectives and principles that can lead to the production of what? Consistent accounting standards is regarded as what? Conceptual framework. So what are the purpose of IASB? So IASB framework assists the IASB in the development of what? Future accounting standard. Let me cite an example. If a particular standard needs to be produced, for instance, a particular topic needs to be produced by IASB. So that is, you want to name a particular IFRS, like the same way we name IFRS 1. So that's first adopters of International Financial Reporting Standard. That's IFRS 1. Then we have IFRS 2, share-based payment transactions. So we have IFRS 3, that's business combination, 4 insurance contracts, then 5 assets at non-current asset for sales. So till IFRS 16, do you understand? So the same way we name all these IFRS, let us want to produce a particular topic which we want to name IFRS so understand. So the framework will now assist the International Standard Board. So International Standard Board are the one responsible for producing IFRS. Do you understand? That's for producing that particular topic which we want to name as IFRS so. You understand? So, or it's also help them to review an existing standard. You know, I said something about IAS. I said IAS, they are going into extinction now. So now let's assume a particular IAS, like IAS 7. That's IAS 7 talks about cash flow statements. Do you understand? Let's assume we want to produce a particular IFRS that will be termed as IAS 7. Do you understand? So, you know, it's an existing already standard. So the IASB will now help to improve in producing that particular standard, because the standard has already been in existence. So that's the reason why we said the IASB in the development of standard. Then it also assists the IASB in promoting harmonization of regulations and accounting standards and procedures leading to the presentation of financial statements by providing a basis for reducing the number of alternatives accounting treatment permitted by international accounting standard. Here, let me say something. I said something about harmonization the other time. So one of the main reasons why we need to harmonize the accounting system is that it will help us to reduce the cost of capital. Do you understand? So it will help us to provide a wider investment choice. Do you understand? So IASB framework will now help the IASB, that is the body responsible for producing international accounting standard, in promoting harmonization of regulations. So because every accounting system used in Nigeria should be harmonized with other parts of the world. That is, the same way we produce statement of financial position in Nigeria should be the same way they will be producing statement of financial position in other part of the world. So then it also assists the national standard setting bodies in developing national standards. So those are the purpose of framework, IASB framework. It also assists the preparers of financial statements in applying international accounting standards. With the framework, it will help us to prepare the financial statement. Let me give you an instance. IFRS does not say anything about the definition of assets, liability, and equity, but the framework, conceptual framework, provide the definition of those things. So without the framework, it will be very difficult for us to know the definition of all these element of the financial statement. When we get to the element of financial statements in the subsequent learning outcomes, I will try to emphasize more on it. So it also assists auditors in forming an opinion as to whether financial statement conform to IAS. You know, auditors, they are the one that gives what is it called? They gives the credibility to the financial statement. Do you understand? So they make the financial statement to be reliable. Once they have certified that this, with their best opinion on this particular statement, it gives a true and fair view. Automatically, we can now rely on that particular statement. Without their assertion, it will be very difficult for us to rely on the financial statement. So it also assists users of financial information in interpreting the information contained in financial statement that comply with what IAS. You know, the end point of preparing the financial statement is just for us to convey the information to the users. Users are the owners of the organization as well as the stakeholders. Do you understand? So the financial statement is not just prepared for the benefit of the owners of the organizations, but also for what? For the stakeholders. So now, these users will be able to form an informed decision on a particular statement once they have the required information that they needed. So, excuse me. Then provide those who are interested in the work of IASB with information on its approach to the formulation of accounting standard. So those are the purpose of IASB framework. So status and scope of IASB framework. The framework describes the basic concept that guides the preparation of financial statement for presentation to a wide range of users. This framework is not an accounting standard. I've said it before. Neither does it override the requirement of any specific standard. So the framework deals with the following. We have 5 things that the framework deals with. 1, the objective of financial statement. Then 2, underlying assumption of the financial statement. Then qualitative characteristics of financial statement. Definition, recognition, and measurement of the element of the financial statement. And last but not the least, the concept of capital maintenance. So let's try to deal with this thing one by one. So what are the objectives of financial statement? Why do we need to prepare the financial statement? I've said it before. I said the financial statement is provided for the what? For the users, for them to have a particular or a required information that they needed, for them to form an informed decision about a particular statement. So it also assists a wide spectrum of users in making useful economic decisions. Because let me give you an instance. If you are part of the owners of a particular organization, and at the year end they produce a particular report. So what you are interested in is their statement of financial position, which is called balance sheets, the statement of profit or loss accounts or other comprehensive income, then the statement of cash flow statement, then their note to the account. So those are the things that you need as a user of financial information. So once you have all this information, you'll be able to decide what exactly you want to do with that particular company. For instance, if you look at their statement of financial position, what you are interested in their statement of financial position is how their asset has been utilized. Do you understand? Then the liability that they have incurred. Do you understand? And the equity. Do you understand? So those are the things that you have interest on. Then when you want to know whether the organization is making a profit or loss, you look at their what? Profit or loss and other comprehensive income. Do you understand? So what I mean by profit or loss and other comprehensive income, you know whether that particular organization is making profit or not. So once the organization is making profit, so you can build your decision on that. Do you understand? Otherwise, you can say, hey, let me don't just waste my time on this particular organization because they are not making profit. So then when we are doing this, we have to identify who are the users of the financial statement. Who are those people who are interested in what? In the financial statement. We have the investors, we have the employees, we have lenders, we have suppliers, customers, government, and the public. And their information needs are provided here. You understand? So those are the things that you need to understand as far as the objective of financial statement is talking about. Then the second thing here is underlying assumption of financial statement. Don't forget, I said there are 5 things in which the framework deals with. One of them is objective of financial statement. The second one is underlying assumption of financial statement. So what are the assumptions that we must follow? It's like the guiding principles. Do you understand? So we have 2 major underlying assumption of financial statement. The first one is acquired basis, while the second one is going concern basis. So these assumptions will help us to prepare our financial statement. Do you understand? So now, let me talk about the acquired basis. Acquired basis is a system whereby when you prepare your financial statements under acquired basis, the effect of transactions and other events are recognized when they occur, not as cash or its equivalent are received or paid. What they are saying here is that if there is a transaction between two entities, once the two parties, when they have agreed to carry on with the transaction, whether they have paid, whether the first party have paid or not, or whether the second party has received or not, the transactions has been binded. So that is acquired basis. The opposite of this is cash basis, and cash basis also is almost used in all these public sector organizations. But with the advent of international financial reporting standard, the only basis that is required is what? Acquired basis of accounting. So then we have the second, which is going concern basis. So under the going concern basis, every enterprise or organization is regarded as going concern. That is, the organization is continuing to exist in foreseeable future. That is no intention to curtail its scale of operation. For instance, if you have intention of having a business, you cannot have at the back of your mind that in the next 2 or 3 years, I will not do the business again. You should have a foreseeable plan for that particular business. So that's what the going concern basis is talking about. So the opposite of this is break-up basis. That is when you just do business for 2 or 3 years, you just say, I want to liquidate. So, and every rational investor or business oriented individuals should not have that kind of what, that kind of assumption. So the going concern basis assumption is very important for every business organization. Then let us look at this objective for this particular questions for objective of financial statement. So this is the solution to the questions. So when you get to your manual, you see the questions. So this is the second. So this is the information about the question. So just look at the materials. It's self-explanatory. It's just talking about the objectives and the two, what is it called? The two underlying assumptions, that is going concern and going concern basis and accrual basis. So now the third one is qualitative characteristics of financial statements. So under these qualitative characteristics, when you are talking about qualitative characteristics, it's just an attribute, or let me say attributes that makes the information provided in the financial statement useful to the users. So the framework identifies 4 principal qualitative characteristics of what? Of financial statement. That shows that it is the framework that talks about the qualitative characteristics, but not what? But not the standard. That is why I said something the other time. I said, sometimes the framework are very, very important, because there are some things that the standard will not talk about, but the framework will emphasize on that particular thing. So now, that is that about the qualitative characteristics of the financial statement. They are the attributes that make information provided in financial statement useful to the users. Without this, they are not useful. So now, let me just say something about these qualitative characteristics of financial statement. You know, when you are talking about characteristics of financial statements, according to the framework, they are divided into 2. We have qualitative characteristics and we have enhanced. In our manual, they merge them together. Do you understand? But I will try as much as possible to separate them. When you are talking about the qualitative characteristics, they are just 2. They are called relevance and faithful representation. That's the 2. Relevance and what? And faithful representation. So try as much as possible to note what I'm trying to say here. So we have relevance and faithful representation. So those are the 2 qualitative characteristics of what? Of financial statement. So the remaining are what? The remaining are enhanced characteristics of financial statement. Information is said to be relevant if it will assist users to evaluate performance. Do you understand? I'm talking about the relevant aspect now. So information is said to be relevant if it will assist users in what? In to evaluate performance and position of what? Of the reporting entity. What is the performance? What is the position? We are talking about the profit or loss and other comprehensive income. And we are talking about statement of financial position. So any information that is relevant, it will assist users to evaluate the performance of that particular organization. It will not assist users to evaluate what? The financial position of that particular organization. So relevant information will be able to compare or capable of making a difference in the decisions made by the what? By the users. So that is what relevance is what is talking about. So, and when you are talking about relevance, you should be able to talk about materiality. So information is material. If its omission, do you understand, or misstatement could influence the decision of what? Of the users. So when you omit any item from a financial statement, or when you misstate a particular item in the financial statement. So the omission and that misstatement now influence the user's decision. Do you understand? So that is why we said the information is what is material. And from this perspective, when we get to the concept of our financial reports, we should be able to explain the materiality of the faithful representation. When you said information faithfully represented, so it means the financial statement should be prepared and presented to represent or reflect faithfully or truly the financial transactions. So that's what we mean by what? Faithful representation. So, and this has to be occur during a particular period. So information must be able to truly represent or faithfully represent the financial transactions that occur during a particular period. So that's what we mean by what? Faithful representation. Then another interesting thing that we need to understand, because when you say something is faithful representation, it has to be neutral, it has to be free from material errors. Do you understand? So then another things we need to understand here is enhanced qualitative, enhanced characteristics of what? Financial statement. Enhanced quantitative characteristics of financial statement. So number one, we have comparability, we have verifiability, then we have timeliness, we have understandability. So we have comparability, then we have verifiability, should be able to verify it. And we have understandability. And we have timeliness. So those are the four enhanced qualitative characteristics of financial statements. So information has to be comparable. You should be able to compare the last year profits with this year profits. You should be able to compare the asset that has been utilized last year with the one you used this year. Let me give you an instance. When you search for annual reports of a company, let's say I want to search for annual report of United Bank for Africa 2022. So when I get to their statement of financial position or statement of comprehensive income or profit or loss account, I will see the information about 2021. You know, I'm searching for 2022. So I will get information about 2021. So the implication is that I should be able to compare the profit in the current year and the profit in the previous year. Do you understand? Then another interesting thing is that you should be able to compare the financial report of a particular company with the industrial average. Or you should be able to compare the financial report of a particular company with the financial report of another company. For instance, as users of financial statements, if you have investments in United Bank for Africa, and you discover that their profit is not encouraging, you can try to look at the market trend, look at other financial statements like Skybank, Union Bank, and some other banks. So by doing so, you should be able to compare the profits generated by all these banks. So be able to know what you are going to do, whether to continue to invest with UBA or discontinue your operation with them. So those are the things that you need to put together for you to compare the financial statement. Then we'll be talking about verifiability. That is, the financial statement should be prepared in such a way that it will enable different, knowledgeable, and independent observers. So that is why it has to be verifiable. So look at when a financial statement has been prepared. So they will try as much as possible to get the service of external auditors to give credibility to the financial statement. So the external auditor, from his or her own opinion, will try to give a true and fair view to that particular financial statement. So that is that about verifiability. Then another interesting thing here is understandability. So every financial statement prepared must not be ambiguous. It must be understandable to the extent that if anybody just look at the financial statements, the information therein should be able to what? Should be able to be clear and understandable. That is, it must not be ambiguous to the extent that the user will find some information therein difficult to what? To grab or to understand. So that is one of the major enhanced qualitative characteristics of what financial statement. Then the last but not the least is timeliness. So information on the financial statement should be made available to users on time. That is, the information is time bound by the users. Users need their information as at when due. Do you understand? So the information must not be delayed. So the financial statement must be prepared in such a way that it must not more than a period, a year. Just as it must not more than a year. So information that is not timeliness is not a good information again. You understand? The relevance or usefulness of an information depends on what? On the timeliness of that particular information. Any information that is delayed is not what? Is not useful again. So now let's quickly move to the next line here. So these are the dramatic representation of the characteristics of financial statement that we just discussed. So then, when we are talking about reliability, so information should be reliable. So reliability is enhanced when the following principles are put in place. So we have substance over form. That is, every transaction has economic, legal, commercial status. You understand? What substance over form is trying to tell us is that so transactions should be accounted for using the commercial status and not their what, and not the legal form. So this can be explained when we are talking about leasing under IFRS 16. You understand? Whereby the lessor grants the lessee the right to use a particular asset. But don't forget that the title of that particular asset is still with what? With the lessor. Do you understand? But the lessee will now record every transaction using the commercial status of the asset. So then we have neutrality. I've explained the information should be objective and free from material bias. That is why we said information is being neutral. Then we have prudence. This neighbor of us should be made to ensure that the position or degree of success of an entity is not overstated. Then we have completeness. Financial information must be complete. If the information is what? So then we have comparability, which I've explained at that time. So what are the elements of financial statement? That's the next line of action. What are the elements of financial statement? When we are talking about financial statement, one of the major, let me just say two major financial statements that mostly recognized is statement of financial position and statement of profit or loss and other comprehensive. So when we are talking about element of financial statement, we are talking about the elements affected those two contents, the statement of financial position and this profit or loss and other comprehensive income. So now, this can now be categorized into two. Element that can be found in the statement of financial position and the element that can be found in the statement of what? Profit or loss and other comprehensive income. Element that can be found in the statement of financial position is assets, liability, and equity. That is why in the accounting equation, we have this. So we have assets equals liability plus equity. So all these elements are found in the statement of what? Financial position. So I will try to explain what assets is all about and liability is all about, as well as what? Equity. That's the first three elements are found in the statement of what? Financial position. So according to the framework, standard does not define this, but according to the framework, assets are the resources that has been controlled by an entity as a result of past events in which future economic benefit will now flow to the entity. That is why we said assets. Look at this building I'm in now. It's an asset of the university. You know, can you imagine the number of students that have passed through this building? Do you understand? So it's the asset, is the resources that has been controlled by the university as a result of past events. Do you understand? In which future economic benefit will now flow to the what? To the entity, that is to the university. Because this building has been generated a lot of revenue for what? For the university. So that is what the asset is all about. So to a layman, asset is what you own. So whatever you own is your asset. So under the statement of financial position, the asset can be categorized into two. We have non-current asset, and we have current assets. Do you understand? So non-current assets are also known as what? Fixed assets, like plants and machinery, or what you can term as PPE, which is explained by IS 16. Property, plant, and equipment. So they are non-current assets. So whereas current assets are just assets that can withstand just a year. So the asset that lapses within a year is what? Current asset, like cash or bank balances and some other things. So now that's about asset. Let me talk about the liability. The liability is just liability is an obligation. I call it a present obligation as a result of past events in which future economic benefit will now flow out of the entity. So that is why liability is what you owe, not what you own. Do you understand? If you let's assume you have a building whereby you are doing a consulting services. Do you understand? And that building has been you use a loan to acquire the building. Do you understand? So that loan that you have used to acquire the building is termed as a what? Liability. So, and that can be long-term liability. We have short-term liability and we have long-term liability. So it's a present obligation as a result of past event in which future economic benefit will not flow out of the entity. So it's an obligation on the part of what? The entity. So then we have equity. You can see from this equation, I can generate my equity to be equals to assets minus liability. So now, if I want to define equity, it's very simple. Equity is a residual interest after liability has been taken care of from the assets. So you have your assets, you have your liability, you've taken care of liability from your asset. Whatever that remains is your what? Equity. That's why we said it's a residual interest after liability has been taken care of from what? From the asset. So after deducting liability from the asset, whatever remains is your what? Equity. So that is that about the elements that you can find in the statement of what? Financial position. Now, let us now look at the elements that you can find in the statement of what? Profit or loss and other comprehensive income, or what we can term as what? Income statement. So we have income and expenses. Income and expenses. So those are the two elements that you can find in the statement of profit or loss and other comprehensive income. So now let us look at the concept of capital and capital maintenance. That's the last learning outcome. Sorry. Concept of capital and capital maintenance. So the framework identifies two concepts of capital. So we have financial concept of capital and we have physical concept of capital. Under the financial concept, the capital is the net assets or equity of the what? Of the enterprise. But under the physical concept, capital is regarded as what? The productive capacity of the enterprise. So that's just the major difference between the financial concept and what? And the physical concept. So under the financial concept, capital is regarded as what? The net assets or equity of the enterprise. But under the physical concept, capital is regarded as what? The productive capacity of the enterprise. So we have the concept of capital maintenance as well. So as with the concept of capital, the framework also identified two types of capital maintenance concept, which are financial capital maintenance and physical capital maintenance. So you can see that there's a subtle difference between the two. So thank you and God bless you. So that's the end of this study unit. If there's any questions, comment, contribution before we call it a day. So the floor is open. Thank you.
Thank you, sir.
Any questions, reactions, comments?
Thank you, sir. I would like to.
Please, I can hear you very clearly, sir.
Can you hear me?
Yes, I can. Yes, I can.
I would like to have a little bit of more clarity.
Please, who is disturbing us now? Please go on, sir.
I want a little bit of clarity on the enhanced characteristics of financial statements. As for my sense, I saw that was mentioned that he said also in the quantitative characteristics.
I'm sorry, I cannot hear you very clearly, but if I can hear you clearly from here, I think what you are trying to say is that I should try to emphasize more on qualitative characteristics of financial statement. Is that your question?
Yes, qualitative characteristics.
I said something. Hello, can you hear me?
I can hear you. Please go on.
Okay. I said something when I started. I said the word qualitative characteristics, do you understand, of the financial statements has been divided into two according to the framework. But as far as the manual is concerned, the manual only specifies qualitative characteristics. And I said we have fundamental qualitative characteristics, and we have enhanced qualitative characteristics. So when we are talking about fundamental qualitative characteristics, we'll be talking about relevance and faithful representation. That is, the information must be relevant and the information must be faithfully represent what it's supposed to represent. So that's the two fundamental qualitative characteristics of financial statement. So the enhanced qualitative characteristics of financial statement, I made mention of comparability, verifiability, timeliness, then understandability. Do you understand? Because in the exams, the examiners might require of you to give two fundamental qualitative characteristics and four enhanced qualitative characteristics. Or if the examiner is lenient, he can say, okay, just give highlight four qualitative characteristics. If the examiner said, highlight four qualitative characteristics, you can give us two from enhanced and two from what is it called? Fundamental. Exactly. So there are two different things. One is fundamental and one is what? Enhanced. So,
thank you.
You're welcome, sir. So, Olatunde, you have the floor. Unmute yourself.
Good afternoon, sir.
Good afternoon.
Yes, sir. Thank you for the class, sir. Please, my question is, I was a little bit late. So,
okay.
Yes. So I didn't know what you've been teaching from the beginning. I didn't even know the topic of the course. I mean, the learning outline. So please,
okay.
Can you
let me just try to brush through the learning outcomes, so be able to be on the same page.
Sure.
So we are talking about the course itself is intermediate accounting. Do you understand?
Okay,
intermediate accounting. So, and in intermediate accounting, we are discussing accounting and reporting concepts. So that's the first study unit, or what we can call study session, accounting and reporting concept. Do you understand? So in the first learning outcomes, we define a conceptual framework of international accounting standard. Do you understand? Conceptual framework of what? International accounting standard, where I've explained so many things. So then in the second learning outcomes, I talked about the status and scope of IASB. So here I said something. I said the conceptual framework deals with 5 major things. 1, the objective of financial statement. 2, underlying assumptions. 3, qualitative characteristics. So that qualitative characteristics now divided into 2. We have the fundamental qualitative characteristics and enhanced qualitative characteristics. Then the 4th one is definition, recognition, and measurement of the element of the financial statement. Do you understand? So whereby I made mention of the element that you can find in the statement of financial position and the element that you can find in the statement of profit or loss and other comprehensive income. Exactly. So now, I said the element that you can find in the statement of financial position are just 3. Then we have assets, equity, and liability. And the element that you can find in the statement of profit or loss and other comprehensive income is income or income and expenses. Do you understand? So those are that's the 4th one. Then the last but not the least is concept of capital and capital maintenance. So we now based our information on these 5 important conceptual framework. That's what we've been discussing since inception of this class. So I hope with the little explanation I just gave, you should be able to understand what we have done.
I understand. Thank you, sir.
You're welcome. So any other questions? I think no more hand. No more hand. Okay. So in the absence of questions, reactions, comments, I think you can call it a day. So take good care of yourself. Bye-bye. So I saw some messages. Okay. Okay. No questions. So you can call it a day. Take good care of yourself. Bye-bye until the next class.